Hi, ladies and gentlemen, this is Alvin from Dr. Wealth, and today's topic is about Snowflake. Okay, recently there has been a lot of sell down in those kind of high growth tech stocks, and Snowflake is one of them. And people are wondering how long can this sell down go on? And today I want to answer that for Snowflake, right? How low can Snow fall? The usual disclaimer, pause and read it if you need to. So let's explain what Snowflake is all about. Okay, so Snowflake is living in a cloud environment and a data-driven world. They mainly help companies manage their data better and also to gain insights from the data. Okay, it can be many departments contributing to the data in different formats, and you put inside a warehouse or even a data lake. And then they have applications to help the consumers of the data to pull out all the relevant information and put in the reports or to make analysis. Okay, so it is a growing and important aspect if you want to really win your competition in the next decade, right, in business. Okay, because if you can get better insights, more accurate insights, and you can tailor your action plan and your strategy a lot better and to compete with your peers in the marketplace and the industry. Okay, so it is at the cutting edge, and any companies more and more are going on board on this journey, right, trying to beat one another. Okay, so you can say that Snowflake is trying to sell the shovels to other companies or the picks and the shovels so that they can fight with one another. Okay, and it has superb business performance. It's one of the best out there. It has over 100% revenue growth, right? Even in the latest quarter, and the revenue retention is very good, right? Above 100% means the existing customer actually subscribe to more services. They pay more money to Snowflake year after year after year, right? That shows that it's very, very sticky, and customers are very satisfied, and that's why they keep buying more things from Snowflake. And you can look at other metrics, right? Even the margins are good, okay? And the contrary is that despite all the stellar performance from the business, the share price have been very disappointing. Okay, you can see from the chart, it's listed not long ago, since October or September last year, all right? And it IPO around $200, and it went up to about 429. That was the peak, and then it was all the way down. Okay, and from a peak to the current price of 188.24 is a 56% down from the peak. Okay, so it's almost like a market crash, just that it was very specific to the high growth tech sector, and Snowflake unfortunately got caught in that because it's one of the companies in this sector itself. And people are wondering, right, since after you've dropped 50% and more, is it a good time to buy, right? Can it go even lower? Okay, so I do think that even after this drop, Snowflake is actually still expensive. Okay, let me explain why. When you look at what Berkshire paid for Snowflake, okay, so this is everyone or who are invested in Snowflake always quote this, right? Berkshire Hathaway also bought Snowflake. It's a good company, no doubt. Okay, it's a good company, but at what price, right? And Berkshire invested at about $120 per share. Okay, that is at the IPO price, right? But because on the first day of IPO, the share price doubled to $200 up to even $300. Okay, so there is a lot of overpaying for this Snowflake stock, even though it's a very good business. And it wasn't Warren Buffett that made the decision. It was Todd Combs who struck the deal after getting to know Snowflake as a customer. Okay, so if at the current price of $188, and if let's say it goes back to where Berkshire had paid for it at IPO, that's still a 36% drop from the current levels, right? So that gives you a sense that, you know, probably last year was an outlier year, that a lot of all these high growth tech stocks have gone up a lot or too much in price, and now it's just a mean reversion kind of effect that's kicking in. And I also pull out some data from publiccoms.com, okay, and I try to compare different kind of fundamental metrics against the market cap compared to the peers in the software space, right? They are also growing very fast, all right? So this is revenue growth versus market cap, okay? So in terms of revenue growth, Snowflake is one of the leading one. Okay, Zoom has an outlier year last year because of the stay at home, and a lot of companies just subscribe to the service, right? But Snow is probably the second fastest revenue growing company in the software space, okay? And Shopify is probably third. And based on this regression line over here, this is to sort of find the market average between the revenue growth and the market cap they should be trading at, right? So it is logical that the higher the revenue growth, the more expensive the market value should be, right? That is something that's very intuitive, okay? So look at Snow is growing about over 100%, right? And based on, if we take the average at the regression line, it should be trading around 40 billion market cap. Okay, now it's trading about 54.3 billion at the time of recording. And if let's say it's at 40 billion, the share price should be $139. And that represents a 26% down from the current levels. Okay, that is to map the revenue growth with its market cap together with the peers in the industry. And let's look at free cash flow yield, the last 12 months versus its market cap. Okay, and look at the free cash flow yield, all right. Technically, you also should, if you can generate more free cash flow, okay, you should be worth more, all right? And look at where Snowflake is. It's still on negative cash flow, okay? You haven't moved on to the positive side, but there's also a regression line that we can take reference from. And if based on this, the market cap for Snowflake should be at about $15 billion, right? So if that's the case, then the share price is as low as $52 or a 72% drop from the current level. Okay, it looks very, very scary with this chart. All right. And the third one that was managed to pull out is the rule of 40. This usually represent more representative metric for the software companies. All right, it's usually for the loss-making ones. They just want to make sure that the revenue growth and the margins eventually is you add up together is more than 40%. So it is okay for a company to be losing money, but the revenue is growing very fast. Okay, so you can just take it as this company are reinvesting back in the business to grow aggressively. Right, as long as they hit this above 40%, then they are considered good companies. All right. So Snowflake, given that revenue growth is over 100%, it's very easy to pass this rule of 40, even if their margin is low. All right. And again, we have this regression line for the industry. And if we map it to that regression line, it should be trading around 37 billion market cap. Okay. And the share price then will be about $128 or 32% from the high. From the current level, not even from the high, right? So there's still another 30% to drop if this is true, okay? So you can see no matter what metrics we use to benchmark against the market cap and against the peers, it seems like Snowflake is still on the higher side in terms of its valuation, okay? So that's why I think that there's still more room for Snowflake to drop further. Okay, so in summary, Snowflake is a top of the class software company, no doubt about it, right? Their fundamentals, their business performance have been superb, and probably that's the reason why that caused the share price to have very rich valuation in 2020, where everyone was in a risk-on mode. Okay, the way to make a lot of money in 2020 is to have a lot of guts and not a lot of logic. Okay, you just go in big time, right? Go in or go big or go home kind of mentality, and that is the best way to make money in 2020. In hindsight, right? Then come 2021, it was the opposite. A lot of all these higher growth stocks actually get whacked down quite a lot. You can see like Snowflake has been down 50% from the high. Okay, so if you have bought risk on in the later half of 2020, then you might have been caught at this point in time. All right, we can see we see the movement of Snowflake. The share price has been doing very well. The IPO popped more than 100% on the first day of trading. From $120 IPO price, it went as high as $319. Right, so that was how crazy the market was in 2020, and it eventually peaked at $429 in December 2020. Okay, and then since then on, it has lost 56% from the peak. Okay, so no joke about it, but it seems like the downfall has not been over yet, and there are still more room for it to go. So I think it could go lower given the market sentiment is still pretty weak for this kind of high growth tech stocks. The risk appetite is not as high as in 2020. Okay, and the worst case is 52, which I don't think so. All right, but judging on what Warren Buffett paid at 120, and after a year it has grown maybe $139 looks like a more logical kind of reference that it could possibly go to, right? And that is still a 26% drop from the current level. Okay, so I don't think minus 72% from this point is likely. It's not impossible, but I just think it's not likely, all right? Whereas $139 from a 26% drop from this level is more likely in my opinion. Okay, so that's my view. All right, can be wrong, can be right, I'm not sure. Let's see how the market pans out. And if you like this video and you like even more videos from us, please subscribe to our channel, and you get an alert whenever we publish a new one. All right, and all the best, and I see you again. Cheers.